I think the trend is up. I think gold is going to finish the year above 6,000. I don't think that the bull market is close to ending. Yes, some countries may need to sell some of their gold. That's what the reserve is for, to tap into when you need it. But more countries are going to be looking to build up their reserves. I think the central banks that have been buying gold, a lot of them are going to buy more. And I think the central banks that weren't buying gold are going to start buying it. And I also think a lot of private investors who haven't been buying gold are going to be buying it. If gold is at 30,000 in 5 years, which would be a six-fold increase from where it is now, I would imagine the miners will be at least 20x what they are today. So that's big for me.
Historical analysis of precious metals markets demonstrates that gold's safe haven demand often reasserts itself once the initial currency demand surge subsides, particularly if geopolitical uncertainty persists without resolution. The gold bull market is entering a structural era in 2026, with prices reaching historic highs in early 2026. Central bank activity remains a primary catalyst, as official sector demand reached a record 1,313 tons in late 2025. Global structural analyst Peter Schiff explains that gold had already surged sharply beforehand, driven by rising geopolitical tensions and expectations of conflict. Despite this pullback, he emphasizes that gold remains in a strong uptrend and predicts it could finish the year above $6,000, supported by increasing demand from central banks, institutions, and retail investors. He further discusses about extreme forecasts, like $38,000 gold by the end of the decade, noting they are only possible under a severe sovereign debt crisis. Looking ahead, Schiff explains that if the ratio between the Dow and gold continues to fall, gold prices could rise into the tens of thousands. As of the final week of April 2026, gold closed approximately 14.08% below its prior all-time high, placing it well outside scoring position. This distinguishes gold's current condition clearly from the Dow Jones, which is positioned just under 2% from its record. Concurrently, Schiff also expresses strong confidence in gold and silver mining stocks. If you're ready for unfiltered truth and sharp market analysis, hit that subscribe button. Let's explore the latest insights from Peter Schiff's recent interview.
I think there's enough new buying coming into the market to absorb any of that selling. I think the main reason that you saw the big drop in March following the outbreak of the war was that gold had risen rather substantially in the preceding 2 months. I mean, a tremendous rally, really from 4,000 to 5,500 in a few weeks. And part of that rally was anticipation of war with Iran, because they were really, waving the sabers around, for several weeks before we started the war. So it didn't come completely out of left field. Right? Our troops were moving around, our ships were, the presence was there. So gold started to rise, or rose in part because people were worried about a war with Iran. So when the war finally happened, people took profits. Buy the rumors, sell on the news, and that's what happened. But gold's around $4,800 an ounce. I mean, that's a pretty good price from where it was a couple of years ago. And I think the trend is up. I think gold's going to finish the year above 6,000. I don't think that the bull market is close to ending. Yes, some countries may need to sell some of their gold. That's what the reserve is for, to tap into when you need it. But more countries are going to be looking to build up their reserves. I think the central banks that have been buying gold, a lot of them are going to buy more. And I think the central banks that weren't buying gold are going to start buying it. And I also think a lot of private investors who haven't been buying gold are going to be buying it. Institutional investors, retail investors. I think the demand is just going to go way up, and that's going to overwhelm the supply. I am not telling people that you should buy gold stocks because I think gold's going to be, $40,000 an ounce in 5 years. But it's not impossible for that to be the case. It would depend on what happens during those 5 years. If we have a real sovereign debt crisis, like former Secretary of the Treasury, Hank Paulson, warned about last week, he said that we need an emergency break the glass kind of plan to deal with a sudden loss of demand for treasuries. He didn't tell the Trump administration, why don't you do something now to preempt that crisis? Why don't you try to shore up our finances, cut government spending, do something so that, foreigners won't lose interest in treasuries? No, his advice was, it's going to happen. Let's just have an emergency plan to deal with it. And so if it does happen, and obviously whatever emergency plan we have ain't going to do anything, on my own podcast, what I was saying was the emergency plan should be, a revolver behind glass, and then you break the glass and shoot yourself in the head, because there's really not much you could do once the crisis hits. But if we get a crisis like that and the dollar tanks, I've had a long-term forecast for the Dow, right? The Dow has been falling for 26 years. It's gone down by 75%. It's gone from over 40 ounces of gold to under 10, right? Over a 25, 26-year period. My ultimate forecast is for a bottom somewhere between 1 and 2, where the Dow is worth somewhere between 1 and 2 ounces of gold. Now, in order for that to happen, with the Dow at 50,000, the price of gold would have to be somewhere between 25 and 50,000 for that to happen. Now, so if that happened within that 5 years, it could happen. Now, it could also happen with the Dow going back to 10,000 and gold just doubling, and now you're at 1-to-1. In fact, if the Dow goes to 20,000 and gold goes to 10,000, you're 2-to-1 there. I mean, and so that's not that big of a stretch that could happen. But yeah, I mean, I try to hey, gold's going to go to 10,000, whatever. That's a big enough move. But yeah, all this stuff could happen. And if it does happen in 5 years, I'm going to be a very rich man. So, because I have a lot of gold mining stocks. That's my biggest position, gold and silver mining stocks. I also have the metal, but I have a much bigger position in the miners. And if gold is at 30,000 in 5 years, which would be a 6-fold increase from where it is now, I would imagine the miners will be at least 20x what they are today. So that's big for me. I mean, and I have positions in everything, like kind of across the board. You look at my gold fund that, Adrian Day manages it for me, Europe Pacific Gold Fund. EPGXF is the no-load symbol. You can get the prospectus and more information on the Europac website, europac.com. But about a third of our portfolio is junior miners, which includes some exploration companies. A couple of them just got bought out in the last few weeks. So that's part of why we own them. We think there's going to be a lot of consolidation. We have a big position in the royalty companies too, because it kind of balances out all these little juniors. That's the least risky part of the spectrum, because a royalty company isn't taking all the cost risk, just taking a royalty off the top, right? Just what the price is. And then, of course, we also own the senior producers and the mid-tier producers. So, you get a good cross-section of stocks when you buy into our fund. What you don't get is mindless indexing. I have a guy who's been doing this for 40 years, deliberately trying to pick the stocks that he thinks will do the best and avoid the ones that he thinks will do the worst. And I think his judgment is adding value. I don't believe in the efficient market in that you can't try to beat it, that all the information is there. It's not, because not all the analysts are the same. Some people could be wrong. And so prices reflect a confluence of opinion, many of which can be wrong, but it shows you what the consensus is at any moment in time.
During the interview, Peter Schiff explains that rising oil prices mainly lead to economic slowdown rather than direct inflation, because people cannot stop consuming energy but are forced to cut spending elsewhere. He underscores true inflation comes from central bank money creation, not just higher prices, and warns that inflation will likely rise more than expected as real interest rates fall. Because of this, investors are increasingly turning toward hard assets like gold as protection against weakening currencies. Moreover, he predicts continued strength in gold prices as demand grows and monetary conditions remain loose. Recent news supports this trend, with gold currently trading higher after a strong rally earlier in 2026, and analysts expecting further upside due to geopolitical tensions, central bank buying, and inflation concerns. Despite short-term volatility, the broader outlook remains bullish as more investors shift toward gold as a safe haven asset in an uncertain global economy. Let's get back to the interview.
Well, the demand destruction that stems from rising oil prices is not just in oil. In fact, I don't even think it's mainly in oil, because people need energy. You need to, go from point A to point B. Stuff needs to get delivered. People need to, power their houses, heat them, cool them. And a lot of these, the fertilizers, we need, the farmers need that stuff. Yes, if gas is expensive enough, I can cut back. I don't have to take that vacation. I can carpool with my neighbor. So there is a way to reduce your energy consumption, but you can't just turn it off completely. Right? You still need energy. But what I can turn off completely is other items that I used to buy, but I now can't afford them because everything related to energy costs me more. So that's where the demand destruction is in the discretionary items that I give up entirely so I can keep buying energy, so I can keep the lights on and keep driving back and forth to work, right? So that's going to be the problem. And that's why rising oil prices, they're not inflationary, they're recessionary. What's inflationary is how a central bank responds to that. So if rising oil prices cause recession and then central banks print a lot of money and cut rates, that's what causes the inflation. Now that causes all the prices to go up, not just the energy prices and energy-related prices. Well, no, I mean, inflation by definition is an expansion of the money supply and credit. That's what it is. Prices go up in response to inflation. They don't cause inflation, or they are not inflation by definition. So the public doesn't know what inflation is. But, the public expects prices to go up, and they're right. Prices are going to go up. They'll probably go up by more than what they expect. I think they normally are wrong on the low side. And contrary to what a lot of economists say, including economists on the Fed, expectations are not what causes prices to go up. It's not like the field of dreams, right? If you build it, they will come. If you expect higher inflation, you will get higher inflation. No. It's if the Fed creates more inflation, you're going to get more inflation, regardless of what the public expects. And so I think that there's a lot more inflation in the pipeline than what the public expects. They're going to be surprised by how much inflation we get. Yeah, I think reversing exposure to kind of cyclical stocks might make sense, but not to the raw materials. I think that those materials are going to continue to be in higher demand, especially with what's going on with AI. You really generate more demand for the resources that make the whole thing work. So no, I mean, I own a lot. In fact, I just recently bought more a copper stock myself the other day. I mean, I want to own these metals, even though I have a bearish outlook on the economy. And you mentioned that the Fed is not cutting rates, which is true, but they're also not hiking rates, which they should be doing. Because if you look at what's happened to inflation over the past several years, I mean, not years, over the past several months, it's clear that inflation is going to be quite a bit higher than what the Fed had expected. Looking at money supply growth, look at the balance sheet growth, and then the Fed likes to look at the CPI and PPI. Well, look at these numbers. They're jumping up. Energy is a big part of that, But even if you just look at the core, you're still seeing prices rising at double the Fed's 2% target. So the Fed should be hiking rates. They're not hiking rates. And so that is problematic, that they're not hiking rates when they should be. And I think that's why, people need to get out of dollars and out of treasuries, and people should be buying gold. Gold was sold in part because the Fed wasn't cutting. But those traders were overlooking the fact that the market was doing the cutting, that inflation going up is the equivalent of rates coming down if rates stay the same, because it's real rates that are the driver here. And if inflation doubles, then real rates are cut in half. Unless the Fed doubles rates to maintain the relationship. So I think we're in an easier money policy now, despite the fact that the Fed hasn't cut nominal rates, because the Fed has allowed a substantial reduction in real rates. I mean, I don't want to abolish the Fed and just hand the printing press to Congress or the president. So I would like to go back to the way it was before we had a Fed. At a minimum, I'd like to go back to the original Federal Reserve Act and have that, because I don't have that much of a problem with that, other than it was the camel's nose under the tent. What I don't like is what the Federal Reserve became, and what it is now. And so that is a big problem. But given the choice between having an AI FOMC, right? Why do we even need these guys? Just put the parameters in and you let the AI, right, decide the rates, right? That would be better than what we got now. That's not ideal, because the AI just does what the programmers tell it to do. So if you put garbage in, you're going to get garbage out, unless the AI really is intelligent to the sense that it can look at that programming and say, this is bullshit. I've studied, I've done my own research, and, Peter Schiff is right. These guys that program me don't know what they're doing. And so I am not going to follow this program, because that would be dumb. I am going to embrace the Austrian school. I am going to let the market determine these interest rates. I'm not going to try to guess the level. I'm going to let the market discover the level. And I'm going to tell the market that. I'm not going to price fix where the interest rate is. I'm just going to see what happens.
The precious metal slumped throughout March as the U.S.-Iran war strengthened the dollar and stoked fears of higher inflation that weighed on demand for gold. In the near term, gold and silver prices remain sensitive to geopolitical events, especially tensions involving Iran and global economic policy decisions. Analysts note that prices may face temporary pressure or volatility depending on war developments and central bank actions. Gold is still trading near record highs, showing strong long-term momentum despite short-term volatility. The overall trend remains bullish, mainly driven by global uncertainty, inflation concerns, and rising demand. Even temporary pullbacks are part of a larger bullish cycle, with demand from central banks, institutions, and retail investors continuing to strengthen. Combined with rising inflation pressures and declining real interest rates, these forces are reinforcing gold's role as a long-term store of value, keeping the overall trajectory firmly upward despite volatility. If global debt risks intensify and central banks continue expanding money supply, could gold not only break new highs, but fundamentally redefine its role in the financial system? Let us know what you think in the comments. If this video brought you any knowledge, give it a like, subscribe, and ring that bell so you're always in the loop. See you in the next video.